Hi everyone, my name is Kritika and today I will be talking about credit. So credit cards, credit scores, everything related to credit. So first, there's some questions that we need to answer before we can get into the discussion of what credit is. The first is, what are debit cards? And then we have, what are credit cards and what is a credit score? So let's start with the first. What are debit cards? A debit card is a card that allows you to instantly draw funds from your bank account when making a payment. So when you have a debit card, all purchases are automatically deducted from your account. So you can't spend any more money than what you have deposited. What are credit cards? A credit card is a payment option where the cardholder is able to pay for goods and services based on a promise to the credit issuer that they will pay them for the amount charged and other additional costs. Credit cards are not instant payments like debit cards. And lastly, what is a credit score? A credit score is a number from 300 to 850 that shows the credit worthiness of an individual. The higher this number, the better. And credit scores are based on a variety of factors, including the number of accounts, so the number of credit cards you have, the number of different credit accounts, debt, and then repayment history. So let's unpack each of these real fast. Let's go back to debit cards. Basically what a debit card is, besides the formal definition of it, is a debit card will just take out the money from your bank account as soon as you buy something. So if you have $500 in your bank account and you're trying to buy something that's $20, you can use your debit card to pay for it, and it'll immediately subtract $20 from the amount that you have. So you'll then have $480 left in your account after you use a debit card. On the other hand, a credit card is not an immediate transaction where the money gets deducted automatically. So with a credit card, if you're trying to buy something that's $20, you can still use a credit card to buy it, but that $20 just gets counted as credit and you haven't immediately paid for it yet. So the way that credit cards work is you can buy something right immediately and promise to pay it back within a certain amount of time. So if you buy something today, you might be able to, with a credit card, you can go back tomorrow and then pay off that $20 from your bank account on a different day. So it gives you a little bit more flexibility with immediately paying for something. If you are waiting for a paycheck, for example, and you get paid tomorrow, but you need to buy something today, you can buy it with the idea that you're promising to pay them back tomorrow once you get that money. So a credit score, like I said earlier, it shows the credit worthiness of an individual. And what that means basically is it's a number that's used to determine if someone gives you money to borrow, if you'll pay it back. So the faster you pay money that you borrow back, the higher your credit score will be. But also if you are consistent with paying back any money that you borrow, then that will also increase your credit score. But we will go over that more in detail in the rest of the presentation. So over here, I have a short sort of comparison list between debit cards and credit cards and the benefits and the negatives of having each of these. So I'll start with debit cards. The pros include no interest, lower fees, can help avoid debt. It's easy to track daily spending. You can get access to cash through ATMs. Some of the cons include you have to pay immediately. There might be overdraft fees, so when you spend more money than what's in your account, and you cannot build credit. For credit cards, the pros include consumer protection and warranties, a line of credit, rewards. You can pay later. You can build credit. Some of the cons are annual fees and interest charges if paid late. So again, let's take a second to unpack each of these and go over in detail what they sort of mean. So going back to debit cards, let's start with the pros. You don't have any interest payments on debit cards because you're paying the money immediately. You're not borrowing any money. They don't charge any interest on it. It's just sort of like an immediate deduction. Debit cards usually have lower fees when you're trying to get a card. With credit cards, you might have to pay a fee in order to apply for a card and get it and then have that account open. They usually are called annual fees sometimes. So with debit cards, there's lower fees and you can work with usually your bank account to get one. Debit cards can also help avoid debt because since you're not spending any more money than you have, you're not borrowing any money from anyone, it's harder to accumulate debt in the same way as credit cards because with a debit card, you're just spending the money you have. Basically, just in a way that's not using cash. So you just spend what's in your bank account. It's like easier than maybe carrying around all of it in cash. You can just swipe your debit card to use it. With debit cards, it's also easy to track daily spending because if you sort of have an idea of how much money you have in your account and how much you're spending, you can keep track of what's left, how much you have remaining that you can spend on other items and sort of budget in that way. Whereas with credit cards, because you're borrowing that money, it's harder to know how much you have and how much you're spending, whereas you are very limited with debit cards. You can get access to cash through ATMs. So usually with a debit card, most of them are also ATM cards. You might sometimes get a separate ATM card, but you can go to an ATM machine, put the debit card in, and get any money that's in your bank account as cash. Some of the cons of having a debit card include that you do have to pay immediately, so you can't spend more money than you have. There might be overdraft fees. So if you only have $15 left in your account, some banks have a minimum that you need to have at least $15, or if you need to have at least $10. And if you spend all of it completely and you go below a certain limit, or you spend more than they let you, more than the minimum amount, they might charge you an additional fee of a few dollars just because you spent more than you have. Which can, over time, if that happens multiple times, it could add up and definitely affect you in that way. Another con is that you can't really build credit. Since unlike credit cards, you're just spending what you have. You're not borrowing it, so it's hard to build. You can't build credit with a debit card. On the other hand, with credit cards, some of the pros include consumer protection and warranties. So credit card companies usually have protection and warranty agreements for their customers. So if there's any sort of fraud or anything like that, they will make sure to take care of it, and you won't get charged if someone's using your credit card to make unauthorized purchases. They will work with you and help you figure that out. And you can always call the credit card company if you have any issues. Debit cards are a bit harder with that because if someone steals your debit card, you're sort of responsible for that. And while they might be able to help you a bit, like your bank, if you call them, the credit card companies offer more protection in terms of you not being held liable. There is also one of the pros is the line of credit. So usually credit cards have a limit for how much you can spend with that card. So starting limits might be $500, so you have $500 to borrow. But as you prove your trustworthiness by paying off your credit card payments on time consistently, they will increase your credit. So you can go from 500 to 1,000 to 2,000, and that is the amount of money you can borrow at a time that they trust you to pay back. The other pros include rewards. So some credit cards offer certain rewards, like you might see things that say cash back, like 1%, 2% cash back, or they might offer discounts on certain things. So depending on the type of credit card you get and from which company you get it from, the rewards will be slightly different. So some of the common ones include usually cash back on grocery stores, which means that if you go to certain grocery stores, such as like, let's say Walmart, for example, you can get for every certain amount of money you spend, you'll get 1% of that back or 2% of that amount of money back as a reward for having that credit card. So Walmart offers a card option, a credit card option with that, that sort of reward system. Another benefit of credit cards is that you can pay later. So the amount is not automatically deducted. You have some flexibility. You can pay off your balance tomorrow, or usually within a certain amount of time. It's like monthly. Within that month, you can pay your balance at any point. So if you're waiting for a paycheck and you needed to buy something earlier, it lets you do that. You can also build credit with credit cards, which is a big one. It can affect your credit score, and if you're consistent and you're able to pay off your balances on time, then it can really help your credit, which then will help you get more loans. It can help you with employment. It can help you just in general with any sort of other credit or funding opportunities that you might need later on. Some of the cons include annual fees. So some of the bigger cards will charge a certain amount of money every year for just having that card. So there might be an annual fee of $50 where once a year you get charged. But these annual fees can go, they can get really, really expensive depending on the type of card. So there might be some with a $0 annual fee, and then you'll see some with like $500 annual fees or really high annual fees. So it's important to sort of pay attention to that and make sure you can also afford to pay the annual fee when you're deciding to get a credit card. Though there are options to make sure that you can get one with a low annual fee. And finally, the last con is interest charges if paid late. So if you are not able to pay back your balance on time, they might charge interest. And over time, this interest can add up and it can be super expensive and basically lead to more debt. The next important thing to note is the credit score. So it is important to understand what a credit score is because employers and renters for apartment buildings, for example, and landlords, they can all check your credit score. So when you look up credit score, you might see something that says FICO when looking it up. FICO is a company that provides scores that measure consumers' credit risk. And FICO scores are a standard type of credit score that is used by financial institutions. It's just the name of it, what it's called. So FICO score is like a credit score that people use. So as you can see here, there's a few different things that influence your credit score: payment history, amounts owed, length of credit history, new credit, and types of credit used. And as you can see, the one with the highest percentage, these percentages all show like what your credit card is composed of and the percent of each that makes up your credit score. So the one that matters the most is your payment history at 35%. So 35% of your score is based on the history of payments. And what that means is basically just if you are consistently paying the money you borrow back. So if you're consistent about that and your history is looking good, then your score will be higher. The 30% number is amounts owed. So that is how much debt you're in, how much money you owe that you haven't been able to pay back. So if you've been really good about paying everything back, your amounts owed should be sort of low, and that will mean that your credit score is higher. Then we have length of credit history. So if you only recently got a credit card for the first time and you have nothing else affecting your credit, your credit score might be kind of low because of that, just because they don't really know if they don't know your history, they don't know how to make up this credit score number. So the longer that you have credit cards, the more consistent you are with your payments, over time, as your length of credit history increases, then your credit score will also go up because of that. Then we have new credit. So that looks at like new sources of credit that you're taking on, the different types of credit used also makes a difference. So if you have credit cards and also loans and other types of credit sources, that can factor in, especially if you're really good at paying all of them back, then your credit score will improve. The opposite's also true. If you have 17 or 18 different credit cards and a bunch of money owed, then your credit score will suffer and be low because of that. So you want to be careful with the number of credit cards that you're opening up. If you're opening up way too many and aren't able to keep up with paying them off, then it could be an issue. So let's go over some benefits of credit cards now. The first is you can earn credit. Employers, loan issuers, apartment renters may check your credit score. And so credit cards can be a good thing because if you're consistently paying them off, if you're building a credit score, then it can help you get an apartment, it can help you get a job, it can help you get a new loan because they can see your credit and see that you are doing a good job. It can also hurt your credit, but if it's used correctly, credit cards can really help with that. Second is rewards. So common credit card rewards include cash back, retail reward points, and airline miles. So like I mentioned earlier with cash back, if there's like 3% cash back every time you go, if you have a Walmart credit card and they give you 3% cash back every time you make a purchase, if you spend like $100, you'll get 3% of that back to keep. You just get that money back essentially. Retail reward points. So sometimes for different stores, like clothing stores, like Macy's, if you have a Macy's credit card, for example, and you're spending money, they might give you a reward and give you like a $10 coupon to spend at Macy's to buy anything. So they'll give you some rewards like that in the form of like cash to spend at their store. So if there's a store that you're shopping at a lot, it might be useful to get one of those, especially like bigger chain stores like Walmart, Target. If you go there all the time for groceries and clothes and things like that, it can be a useful reward. There's also airline miles. So if you are flying a lot, which is a bit hard because of the pandemic now, but if you are one to travel a lot for your job or anything like that, or just visiting family, the airline miles, every time you buy a ticket, those miles can add up and you might get some rewards to like be able to fly different places. They might give you like 10,000 miles or something like that you can use on trips. And every time you book a flight, you might get some sort of reward for that. Third, we have safety. If there is a case of fraud and you use a debit card, the money is automatically missing from your account. If there are fraudulent charges using a credit card, you can contact your credit company to resolve the matter. So with debit cards, if someone spends $30 and uses your debit card, that money just gets deducted immediately from your account and it's gone. So with a credit card, you have some flexibility and you can contact the company and say, like, I didn't actually make this. They can remove it from your account and you don't have to worry about paying it back. Usually you can resolve it with them. The fourth benefit is delayed payment. So when you charge your credit card, you have a grace period before you have to pay the bill. So this allows for more flexibility, like I mentioned earlier, with larger payments, especially if there's something that you need to buy that's pretty expensive and you don't have enough money in your account immediately, but in the next few days, you'll be able to pay it off. Then credit cards gives you that flexibility. Then we have some complications with credit cards because credit cards can be pretty complicated sometimes. First is interest. If you don't pay your balance in full, you may be required to pay interest on your remaining balance. Some credit cards have very high interest rates, which can add up over time. So that's one thing to be very careful of, making sure you know what your credit card interest rate is and seeing if it's in sort of a reasonable range. And usually you don't want to get to that point where you're spending more than you can pay off with your remaining balance, because it can add up super fast and get very complex and create a lot of debt. The second is annual fee. So many credit cards have an annual fee you're required to pay. I mentioned earlier, they can be from $0 to $500. It really depends. It could go even higher. So that's just something to be aware of, that you'll be required to pay that every year. Third, we have payments. If you aren't able to make your payment in time, your credit score will likely decrease. So that is part of the credit history that we looked at earlier. We saw the payment history, that's 35% of your credit score. So making your payments in on time is super important, not just because of interest that you might get charged, but also because of your credit score. Lastly, we have usage. If your credit card has a low credit limit, it may be difficult to make large purchases. Normally they start with $500 though, but if you're trying to make an extremely large purchase that's more than $500 at one time, it might be hard because some credit cards don't immediately give you that option. You have to build it over time. So they start with 500. Then after good payment history for a few months, then they'll increase it and then increase it again. So if there's a low credit limit at the beginning, it might be hard. Questions to ask before applying for a credit card. The first one is, can you pay your balance in full by the time it's due? So these are all things that you can ask yourself just to see if you're ready to get one. If you aren't able to pay your balance, your credit score will likely decrease and you may have to pay interest. So that's something to be aware of. If you're able to pay your balance in full, there are, like I mentioned earlier, so many different benefits that are really great. But this is just something important to make sure that you have to pay that balance in full by the time it's due. The second is, are you applying for this card with the intention of closing it? So retail stores often offer special rewards for opening a credit card. However, opening and closing too many accounts can actually lower your credit score. So we saw earlier that new credit and types of credit are all different factors that influence your credit score. And while we do want to have a good mix of different credits and have like different accounts, having way too many or opening them and just to close them right after the reward is you've used up the reward, that can lower your credit score and actually factors into the score and influences it. So you might see different stores offer like get $300 off you open a credit card today and things like that. But if you do it just so you can close it tomorrow, it could harm your score. The third is, do you have other credit cards open already? So too many accounts may be confusing to keep track of. So if you have like 10 or 12 different credit cards and you aren't able to keep track and pay each one off, then you might forget about one. There's always a risk that you don't remember to pay something, especially because a lot of them have annual fees. If you have a credit card that you haven't used in a really long time and there's an annual fee on it and you aren't monitoring it carefully and checking, you might have to pay interest and it might create some debt there. So it can be difficult if you have way too many cards to keep track of everything. For this, what do you plan to use the card for? And spending on your card should amount to 30% of your credit limit or lower. So that is like part of what affects your credit score is like how much of your credit card limit you're using. And so if you have a credit limit of $500, which is the usual intro rate, like I mentioned earlier, you should be using only 30% of $500 or lower at a time before, and you should be paying it off. So you're at that 30% or lower ratio. So when should you own a credit card? If you're debating to get one or not, these are some things that maybe can help your decision to get one. You understand and are aware of all the risks that come with owning a credit card. You are confident in your payment history. You are ready to responsibly use a credit card. Those are all times when you might be ready to own a credit card, when you're aware of everything, all the risks that come with it, and you're confident that you can responsibly use it. When should you use a credit card? You would like to build credit. You would like to wait before paying off the purchase. You do not have to use it on a regular basis. This is just a side note. You can open a credit card for the purpose of building credit and spend a limited amount of money on it each month. So if you are trying to build credit, using a credit card can be good. If you're making Small purchases that's 30% under your credit limit, and you're paying it off consistently, that is the time to use your credit card. It can be very helpful. If there is anything, like I mentioned earlier, that you need to buy something today and just need some flexibility before your next paycheck comes in, but then you know you can pay it off, that is also a time when you can use a credit card. And yeah, the side note, just you can open up a credit card and give yourself an amount. Like, I'm only going to spend $50 on it or something like that. Whatever amount that matches up with your credit limit, and it's like that 30% ratio, you can give yourself that limit to spend on it each month and pay it off consistently. So how do you apply for a credit card? You need the following information when applying: your social security number, your estimated income. So they might ask for taxable and non-taxable income. So be sure to have all of that information readily available. Your home address. Some credit cards may also ask for career information. So they might ask for your employment, like where you work and things like that, and ask you to put that when they ask you for your estimated income. Another question to consider is which credit card. There are many different factors to consider when finding the right card. The following factors are a few that are important to consider among many others. First is low interest. Look for the word APR. APR stands for annual percentage rate, and it's the annual rate charged for borrowers. And so this can be the rate you pay if you make late payments or you go over your credit limit, that like payment, that interest that they make you pay. This number is important to look at to figure that out. There are cards that offer a low interest rate on your monthly balance, and that's a good thing. So we want to look for cards that have low interest rates and not super high interest rates. But there are some cards that have low intro APR promotions. And what that means is low intro APR promotions allow you to not pay interest for a few months after opening an account. However, these types of promotions can be dangerous if credit card companies are enticing you to sign up for a card. So be sure to look at the long-term rates after the intro offer has expired as well. You can also get rewards and secured credit cards are all different things to consider. But going back really quickly to low intro APR promotions, this is super important because a lot of these companies sometimes will try to entice people by saying there's no interest, it's 0%. But after a month or two, or even a few months, they might increase it and make the interest rate really, really high. So if you're using it to try to get out of debt and are spending above what you can pay, after a few months, you might have an extremely high interest rate to deal with, and that can add up a lot and actually get you into debt way faster. So the long-term rate is also very important to look at when looking at these like intro offers. Then we have rewards to consider. Like I said earlier, there are rewards from cash back to airline miles to so many different types of rewards, and that'll usually be very clear on the website. It'll tell you why you should get their card. Every company will have some sort of brief like spiel about rewards and what they offer. Also, there are options to get secured credit cards, which require you to pay a refundable deposit, which then becomes your credit limit. So with these, you can pay a refundable deposit of, let's say, $500, and that's now your credit limit. So you can't spend more than that, and you spend in relation to that. So it just offers an extra sense of security. And that is all for today on credit scores and credit cards, credit in general. If you have any questions, please feel free to reach out. Thank you.